A building worth $50 million is simultaneously worth zero on paper, and that's entirely legal. The mechanism that makes this possible is called depreciation recapture, and it sits at the intersection of tax code and real estate finance. It's not new, it's not hidden, yet most people who own property have never heard of it, while those who understand it have built fortunes inside its architecture. The question we need to answer is simple. How does an asset lose value on a tax return while gaining it in the real world? Start here. The Internal Revenue Service allows property owners to deduct the theoretical annual loss of value, depreciation, from their taxable income. A $10 million apartment building under current tax law loses value on paper every single year, even if its market price climbs. That deduction reduces what owners owe in taxes. The system assumes buildings deteriorate. The math is standardized. A residential building depreciates over 5 years, a commercial one over 39 years. Here's where the system reveals its peculiarity. An owner deducts that depreciation year after year, cutting their tax bill significantly. But when they sell, the IRS demands recapture. It taxes the difference between what they deducted and what actually happened. Except here's the trap. The recapture rate is often lower than the ordinary income tax rate, so the owner pays less tax on the gain they never actually lost. The math becomes clearer with a concrete case. Suppose someone buys a commercial property for $5 million. Over 15 years, they deduct $2 million in depreciation. Their taxable income shrinks annually. They pay less tax. Meanwhile, the property actually appreciates to $8 million. When they sell, they owe tax on the $3 million gain, but the $2 million in prior deductions. That's taxed at the recapture rate, historically 25%, not the higher ordinary income rate they might face otherwise. The feedback loop is what makes this a system, not an accident. The lower recapture tax incentivizes purchase. Lower purchase friction means more capital flows into real estate. More capital drives prices up. Rising prices make the depreciation deduction more valuable in absolute terms. Owners deduct more, pay less tax, and accumulate more capital to deploy again. The mechanism feeds itself. But there's a second layer. Many ultra-wealthy owners never sell. They hold property until death. When they do, their heirs inherit at what's called a stepped-up basis. The IRS essentially resets the depreciation clock. All those deductions the original owner claimed, erased from a tax perspective. The heir starts fresh with a new depreciation schedule on a property that has appreciated for decades. The prior tax advantage vanishes, but the wealth doesn't. This is why the system predictably concentrates wealth. Someone with limited capital cannot use depreciation recapture effectively. The deductions matter only if income is high enough to benefit from them. Someone with $1 million in annual income can absorb and weaponize depreciation. Someone with $5 million can accelerate it. The mechanism is proportional to existing wealth, which means it amplifies existing wealth. The political economy piece is worth noting. Depreciation recapture exists because Congress built it into the tax code decades ago, with the stated intent of encouraging real estate investment and development. It worked. Capital flowed into buildings. Cities grew. But the mechanism was never adjusted proportionally when wealth concentration accelerated. The rule that made sense at one scale became a tunnel for fortunes at another. Who predicted this? Economists studying real estate markets have long flagged that tax incentives distort price signals. When depreciation deductions make property more attractive than the underlying rental income justifies, prices climb faster than fundamentals warrant. That's predictable. It's happened repeatedly, and each time the system absorbs the lesson and continues. The question then shifts: why does depreciation recapture persist? The answer is structural. Real estate is politically powerful. Developers, landlords, and property funds lobby to maintain favorable tax treatment. The benefits are concentrated among a relatively small group with significant resources to defend them. The costs are diffuse, borne by other taxpayers through higher rates or reduced services. Concentrated benefit plus diffuse cost equals durable policy. There's also a behavioral component. Depreciation recapture is complex. Most people don't understand it. That opacity serves the system. If the mechanism were transparent and widely understood, pressure to modify it might grow. Instead, it operates largely in the domain of accountants and tax strategists. Complexity itself becomes a form of protection. The international dimension matters too. Depreciation recapture applies to domestic property, but wealthy individuals and corporations often structure ownership through entities, trusts, LLC corporations that can be domiciled in low-tax jurisdictions. The property sits in the United States. The depreciation deductions flow to owners sheltered elsewhere. The mechanism now operates across borders, amplifying its effect. So how does a $50 million building become worth zero on paper? Its owner deducts depreciation aggressively. Over decades, the cumulative deduction approaches or equals the original purchase price. On a tax return, the asset has minimal basis, but in the real world it generates rent, appreciates, and serves as collateral for loans. The divergence is the entire point. The system allows wealth to be real while income is invisible. The collapse scenario analysts worry about is what happens when this system meets stress. If interest rates spike, property values fall, or depreciation deductions can't be fully utilized because income is insufficient, the mechanism reverses. Owners face margin calls on loans backed by properties with low tax basis but high debt. The system that seemed stable becomes fragile. That fragility was always embedded in the structure. Some jurisdictions have attempted to modify depreciation recapture. They've raised recapture rates, limited deductions, or created alternative structures. The results have been mixed. Capital often shifts to friendlier tax environments. Developers adjust financing structures. The system adapts. This is why understanding the mechanism matters. It shows that policy changes alone, without structural redesign, often fail to address the underlying dynamics. The deeper pattern is this: depreciation recapture is one mechanism among many that allow accumulated capital to generate further capital while minimizing taxation. It's not unique. Similar structures exist for equipment, intellectual property, and financial instruments. Together, they form an ecosystem in which wealth doesn't just grow, it becomes invisible to the tax system. Understanding one is a lens into all of them. So the original question, how does a building worth $50 million become worth zero on paper, now has its answer. Depreciation recapture allows owners to deduct value that the market never actually lost, creating a permanent gap between real and taxable wealth. It's legal, it's intentional, and it's proportional to existing capital. The system works exactly as designed, which is precisely why it persists. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for weekly deep dives into the financial mechanisms that shape wealth and power, the ones most people never see. This video is for educational and informational purposes only and is not financial advice. Always do your own research.